You think your retail broker is doing you a favor. You sit in their glass office, drink their sparkling water, and assume their standard 1.5% advisory and fund fee is a minor cost of doing business. But that single, seemingly harmless number will mathematically confiscate 35% of your total lifetime returns over a 30-year timeline. You believe that a 1% or 1.5% fee means you keep 98.5% of your money. You are failing to realize that Wall Street does not take a percentage of your profits. They take a percentage of your total asset base every single year, compounding in reverse against your future wealth. Today, you will master the mathematics of the AUM, meaning assets under management, the total dollar amount the bank holds for you. You will learn to read a fund prospectus like an institutional allocator, and you will legally claw back the six-figure wealth transfer you are currently handing to the financial sector. Stop acting like a tourist in the market. The exact order money must leave your account on payday begins with plugging the holes where the bank is draining you. Let us examine the exponential decay of the AUM fee. This is the first rung of real wealth retention. If you earn an 8% gross return being the money your investments make before the bank takes its cut, a 1.5% fee does not take 1.5% of your money. It consumes nearly 20% of your annual growth, and because that money is gone, it cannot compound for you the next year. Over decades, this compounds into a catastrophic loss of principal being the original dollars you actually worked for and deposited. Look at the real numbers. Take a $1,000 million Cently investment from 1996 to exactly today, August 2026. A 30-year timeline. At an 8% gross return with a 0.03% Vanguard ETF fee, you have roughly $1.48 million right now. Your money worked for you. But what happens if you bought an actively managed mutual fund from a retail advisor charging a standard 1.5%? With that 1.5% fee eating your asset base every single year, your final balance is just $1.08 million. The fund manager did not just take a small fee. They confiscated $400,000 off your final net worth for matching the exact same market performance. They built their wealth using the compound interest that mathematically belonged to you. Let me explain how this mechanism operates in the dark. The fee is calculated daily and billed quarterly. If the stock market drops 20% this year, your advisor still takes 1.5% of whatever is left. When your account reaches $500,000, that 1.5% fee is $7,500 for that year alone. If you are only saving $12,000 a year from your salary, the bank is quietly neutralizing more than half of your manual labor. It is a tax on your success. The larger your portfolio grows, the larger their undisputed cut becomes, regardless of their performance. You are carrying a parasite that scales with your net worth. Do you understand the 8 to 9 figure reality of the wealth management business model? Institutional billionaires do not pay retail fees. When we structure a $100 million family office portfolio today in 2026, we bypass retail products entirely. We secure institutional share classes funds restricted to massive accounts at 0.02%, or we build direct indexing to own the stocks outright. Retail investors, on the other hand, are deliberately herded into high-margin A-shares or target-date funds loaded with embedded 12B1 marketing fees. A 12B1 fee is literally a charge you pay so the mutual fund can run television commercials to acquire other suckers. This is entirely designed to subsidize the bank's overhead. Look at the mergers and acquisitions activity in the wealth space right now as of early 2026. Private equity firms' investment groups that buy companies to scale or strip them are buying up registered investment advisors, or RIA, at massive multiples. An RIA is simply a corporate entity legally established to manage your money for a percentage fee. They are paying $250 million to acquire RIAs that have $10 billion in assets under management. Why? Because that 1% AUM fee guarantees $100 million in annual cash flow. Even if the stock market crashes and they do absolutely nothing, They still collect tens of millions. They are securitizing your financial ignorance. They package up your inability to read a fee schedule and sell it to private equity as an annuity. To stop this, we execute the surgical extraction of the intermediary. You must locate the gross expense ratio on your 401(k) or brokerage statement today. The expense ratio is the legally required disclosure of what the fund manager takes. Always look at the gross ratio, not the net. The net is a temporary discount to lure you in. The gross is what they will eventually charge you. You must ruthlessly liquidate any passive or pseudo-active fund, charging over 0.10%, and reallocate that capital to broad market index ETFs. Let us take a standard retail investor making $75,000 a year right now in 2026. They are contributing $500 a month to their company 401(k). They discover their money defaults into a legacy American Fund's target date vehicle, charging 0.75%. That fund might also carry a front-end LODA sales commission taken out of your cash before it even gets invested. They log in and they shift that $500 allocation to a Fidelity 500 index fund, ticker FZAKES. The FZAKES expense ratio is 15%. By literally clicking 3 buttons to change their investment election, this average earner recaptures over $120,000 in projected future capital without earning a single extra dollar in salary. This requires sociopathic vigilance. Your financial advisor at the retail bank is not your friend. They are a commissioned salesperson whose literal job description is to intercept your compound interest. You must protect your capital, treating every basis point of fees a basis point being 1/100th of 1%. Wall Street's preferred unit of invisible theft as a direct robbery from your future self. Here is your assignment. You will log into your 401(k) or brokerage portal by 8:00 p.m. tonight. No delays. You will locate the expense ratio or prospectus tab for every single fund you hold. If any number begins with a 1 or even a 0.5, you will sell the position tomorrow morning. You will immediately buy a broad market index ETF with an expense ratio under 0.05%. You will execute this trade and cut the parasite off. I know the excuse you are whispering to yourself right now. I don't have enough invested yet for a 1% fee to matter. I'll optimize my portfolio when I actually have real money. Wall Street builds its skyscrapers using the pennies you were too lazy to count. Do the work, then report back for the next rung of the ladder. Next time, the $120,000 trap. Subscribe, you do not want to miss it.